A massive beat for Teledyne Technologies today, setting all-time company records. They just reported Q2 2026 revenue of $1.66 billion, which is up 9.8% year over year.
And, the bottom line is even more aggressive.
Yeah, exactly. So GAAP diluted EPS came in at $5.37, but the non-GAAP diluted EPS hit $6.28.
Right, which is an outsized, like 20.8% structural jump compared to last year.
It's massive. And management didn't just, take a victory lap for the quarter. They actually raised full year 2026 guidance across the board.
Yeah, they bumped the GAAP EPS outlook to a range of $20.73 to $20.65.
Plus, they fortified their overall market position with a staggering $5 billion in funded backlog.
$5 billion. I mean, that is just a wall of future revenue sitting there.
Right. So, for everyone listening, our mission today is to tear down these numbers segment by segment. We're going to look at the underlying mechanics of this margin expansion, dissect exactly how management is deploying this, massive influx of cash, and analyze the intense macroeconomic and geopolitical risks Teledyne is actively navigating right now.
Because it is rare to see this level of structural efficiency in the current environment. When a company manages to increase top-line revenue by nearly 10% and then flow that down to a 20% jump in non-GAAP earnings.
It's a huge leverage ratio.
Exactly. It signals that their manufacturing base is fully optimized. But we also need to recognize why that non-GAAP number is nearly $1 higher than the GAAP figure.
Right, the acquisition history.
Yeah, Teledyne is a serial acquirer. So their GAAP earnings are consistently weighed down by the amortization of intangible assets from all those past buyouts.
Which makes sense.
Right, so stripping those out to look at non-GAAP gives us a much clearer picture of the actual cash-generative power of their core operations today.
Which brings us directly to the division that did the heavy lifting this quarter. Digital imaging.
Oh, absolutely the star of the show.
The data here is remarkable, but, it warrants some heavy scrutiny, too. Sales for the segment hit $868.7 million. That's a 12.7% increase year over year.
A solid double-digit bump.
Right, but operating income for the segment skyrocketed to $170.2 million. That is a 42.3% surge compared to the same quarter last year.
It's just wild.
It is. Executive Chairman Robert Mehrabian highlighted that this growth was primarily organic, though, they did get a minor $6.1 million bump from a recent acquisition.
Yeah, they cited demand for infrared imaging detectors and systems, mostly for space, airborne, and marine unmanned systems.
Plus counter-unmanned applications. Basically, digital imaging is the eyes and optics of modern defense and industrial tech.
That's a great way to put it, yeah.
But I have to push back on these numbers a bit. A 12.7% increase in sales driving a 42.3% increase in profit. That is a totally asymmetrical leap. How do they physically squeeze that much profit out of a relatively marginal increase in volume?
It's a great question. And the mechanics behind that margin disparity are fascinating. It comes down to a concept we always look for as analysts. Favorable product mix.
Meaning they aren't just selling more stuff, they're selling better stuff.
Exactly. You don't get a 42% profit jump just by selling more of the same baseline units. You get it by shifting your volume heavily toward highly specialized high-margin units.
Ah, okay.
In Teledyne's case, they tilted toward those high-end infrared systems for defense and space and likely sold fewer lower-margin commercial or industrial cameras. When the mix tilts toward the premium end of the catalog like that, profits just scale exponentially faster than raw revenue.
Okay, but product mix alone can't bridge a gap that wide. A 30% delta. There has to be an operational or accounting mechanism at play as well, right?
There is, yeah. They also recorded significant tariff refunds in this quarter.
Oh, interesting.
Right. So in previous quarters, Teledyne had to pay import duties on certain specialized electronic components they source from overseas.
And they fought those charges.
Exactly. When they successfully appeal those classifications or get exemptions, the government cuts a check. That retroactive refund acts as a pure one-time injection straight to the operating income line.
So we have a structural driver with the better product mix and a one-time accounting driver with the tariff refund. But they didn't get a free pass on costs either. The report actually notes they had to absorb higher research and development expenses and higher inventory reserves.
Which honestly makes that 42.3% profit jump even more impressive.
How so?
Well, let's look at the mechanics of those headwinds. They're taking higher inventory reserves, which typically means they're writing down the value of older, obsolete parts.
Which is just a standard reality when you operate on the bleeding edge of tech.
Right, hardware gets old fast. And simultaneously, they're aggressively funding R&D for the next cycle of optics. So the core business performed so efficiently that it entirely swallowed the cost of obsolete inventory, funded future innovation, and still spit out record margins.
Wow. But, if digital imaging is pulling in those kinds of record margins, the natural question is whether the rest of the business is keeping pace or if that main engine is just masking leaks elsewhere.
Yeah, a healthy company needs all its organs functioning.
Exactly. So let's look at the other three segments, starting with instrumentation. Sales rose 5.5% to $387.8 million.
Driven mostly by marine and environmental tech, right?
Yeah, a $9.7 million increase in marine instrumentation tied to offshore energy and defense, and a $7.2 million increase in environmental instrumentation. But here is the catch. Operating income for instrumentation actually shrank by 0.2%, dropping to $101.4 million.
Which is a huge contrast to digital imaging.
Right. If top-line revenue is up but profit is down, are they just buying hollow growth? Is this a red flag? Because to me, it looks like a car dealership selling more cars, but realizing at the end of the month that they only moved base models instead of the luxury trims.
The base model analogy captures the mechanism perfectly. It is the exact inverse of the digital imaging scenario.
Okay, so it was the product mix again.
Yeah, the company explicitly stated that the decrease in operating income was caused by an unfavorable product mix. In the marine space, which heavily serves offshore energy, demand is surging right now due to global energy constraints.
Right, everyone needs more oil and gas tech.
Exactly. But Teledyne is likely moving more commoditized, lower-margin sensors and connectors to meet that volume, rather than their fully integrated, high-value, autonomous underwater vehicles.
So they are capturing market share, but the profit per unit is dilutive to the segment's overall margin.
Spot on. Now, moving on to aerospace and defense electronics, we see a totally different dynamic.
Yeah, solid performance there. Sales came in at $286.4 million, which is an 8.2% increase. And that was driven almost entirely by a $20.8 million boost in defense electronics.
While aerospace electronics barely moved the needle, adding just $0.8 million.
Right. But operating income grew 11.9% to $74.5 million. And I noticed there is no mention of product mix or tariff refunds here. The company simply attributes this to higher sales volume. How does volume alone drive that much margin expansion?
Because defense electronics manufacturing is a classic study in fixed cost leverage.
Walk us through that.
Sure. Developing and certifying secure communications or avionics for military platforms requires immense upfront capital. You have to build specialized, highly secure facilities, maintain personnel with top-secret clearances, and you pay for all of that regardless of whether you produce 1 unit or 1,000.
Right, the overhead is basically locked in.
Exactly. So once you cover those heavy fixed costs, the marginal cost to produce the next unit drops dramatically. By pushing that extra $20.8 million in volume through their existing factory footprint, the profit drops straight to the bottom line.
It just naturally expands the margin.
Exactly.
Okay, finally we have engineered systems, which is their smallest division. Sales were up 8.4% to $119.6 million, but operating income surged 24.8% to $15.1 million.
Again, they cite program mix as the driver.
Right, selling more engineered products and energy systems. What exactly is an engineered product in this context?
Usually it refers to highly customized low-volume systems, things like specialized life support or water purification systems for defense applications.
So not off-the-shelf items.
No, these are bespoke engineering contracts. When the mix of these active programs shifts toward later stages of development or enters active production, the margin profile improves drastically.
Makes sense. So if the underlying operations are humming along with this kind of fixed cost leverage and favorable mix, the subsequent influx of capital has to go somewhere.
Which brings us to the balance sheet.
Right. The cash flow statement in this report reveals exactly what management is prioritizing. Cash provided by operating activities hit $315.2 million for the second quarter.
Which is up substantially from $226.6 million last year.
Yeah. And after capital expenditures, they generated free cash flow of $284.7 million.
The raw cash generation is notable, but the underlying mechanisms really show a company optimizing its working capital. I mean, the increase wasn't just from higher operating profit.
Right. It was also aided by low income tax payments in the quarter. But the real story for retail investors is how they deployed that capital. They took that operating cash and made a massive $450 million debt maturity payment right at the beginning of the quarter.
$500 million just cleared off the board.
Yeah, it brings their total net debt down to $1,686.9 million. This leaves them with a quarter-end consolidated leverage ratio of 1.1x.
And we really need to pause on that 1.1x figure.
Why is it so crucial right now?
Because a 1.1x leverage ratio, which is just net debt to EBITDA, is essentially a structural weapon in today's macroeconomic climate.
A weapon.
Yeah. Consider the broader market. The cost of capital is incredibly high right now. Smaller competitors who relied on cheap debt over the last decade are choking as they try to refinance their obligations at current interest rates.
Right, they're forced to scale back R&D or divest assets just to survive.
Exactly. While Teledyne is aggressively deleveraging, by paying off nearly $500 million in debt without rolling it over, they actively reduce their interest burden.
Which shows up on the income statement. Their interest expense dropped from $17.6 million down to $13.6 million.
And this is where Robert Morabian's commentary becomes critical. He stated, "Given the strength of our balance sheet, we continue to review a number of acquisitions."
Ah, they're going shopping.
Big time. When your leverage is at 1.1x, while the industry average might sit closer to 2.5x or 3.0x, your balance sheet is basically a dry powder keg.
Because if they identify a struggling competitor with compelling tech, they don't need to issue expensive equity to buy them.
Right. They can just tap a credit facility or use cash on hand, acquiring distressed assets at very favorable multiples. They are structurally positioned to be an apex predator in this sector's consolidation phase.
It's a huge advantage, but, no company operates in a vacuum, no matter how clean the balance sheet is.
Oh, absolutely not.
And every earnings report has a risk factor section, but reading through Teledyne's forward-looking statements feels like reading a geopolitical thriller.
Yeah, they do not hold back.
The geopolitical threats they outline are granular and severe. They explicitly call out the 2026 conflict between the United States and Iran, tracing the specific ripple effects it could have on their manufacturing base.
And I think it's important to note, they aren't just citing generic geopolitical instability to cover their bases legally. They are identifying the physical bottlenecks that occur when global supply chains intersect with conflict zones.
Like higher energy costs and shipping disruptions.
Right, which are immediate consequences of tension in critical maritime choke points, like the Strait of Hormuz. But the most revealing detail to me is their warning about shortages of critical materials, specifically naming aluminum, metals, chemicals, and industrial helium supplies.
Yeah, the mention of industrial helium is the key to understanding this risk. Because why does a defense and aerospace tech company care about helium?
It connects directly back to their STAR segment, right? Digital imaging.
Exactly. High-end thermal imaging and infrared sensors, especially those deployed in space or advanced airborne applications, they require cryogenic cooling to operate effectively.
Because otherwise they run too hot.
Right. If the sensor's too warm, its own thermal noise blinds it to the target it is trying to detect. So helium is the essential element used in those advanced cooling mechanisms.
Which just perfectly demonstrates the fragility of modern defense manufacturing. Teledyne can secure billions of dollars in government contracts for infrared defense systems, but if a conflict thousands of miles away snaps the supply chain for industrial helium,
they physically cannot finish the product.
Right. Revenue recognition halts, and that beautiful cash flow cycle we just analyzed comes to a grinding stop. They also explicitly cited the risk of retaliation against U.S. targets by Iran or its proxies, elevating the physical security risks of their operations.
And the risks aren't solely overseas either. They detail significant domestic and trade risks, specifically calling out the impact of U.S. presidential administration policies.
Yeah, and we need to be clear for the listeners, we aren't taking any political sides here. We are just reporting on what Teledyne explicitly listed as threats to their revenue.
Exactly, just looking at the math. The document warns of new and higher tariffs, cutbacks in the funding of government agencies, and the scaling back of environmental and green energy policies.
That environmental policy risk directly threatens the environmental instrumentation growth we noted earlier. If a new administration slashes green energy funding, the market for those specific environmental monitoring sensors basically evaporates.
Yeah. Furthermore, they highlight the escalating economic and diplomatic tension between China and the United States, raising the specter of a trade war that would impose even higher tariffs and restrictions on the sale of goods.
And don't forget the persistent threat of U.S. government shutdowns.
Oh, right, which they called out as well. A shutdown doesn't automatically cancel a massive defense contract, but it paralyzes the bureaucratic machinery required to execute it.
Yeah, the report notes it results in delays in contract awards, delayed invoice payments, and halts in issuing export licenses.
Basically, the government stops cutting checks, which jams up Teledyne's working capital.
Exactly.
Yeah.
And there's one more risk factor that really requires unpacking, as it illustrates the domino effect inherent in industrial manufacturing. They explicitly warn that lower aircraft production rates at Boeing or Airbus could negatively impact Teledyne's commercial aerospace products.
Yeah, it is the ultimate supply chain cascade. It shows how interconnected these markets are. Think of the global aerospace supply chain like a tightly wound mechanical watch. A broken gear on the assembly floor in Seattle or Toulouse doesn't just stop the plane from being built. It freezes the hands on the watch for every supplier down the line.
Oh, absolutely.
If Boeing slows down production due to regulatory scrutiny or internal bottlenecks, Teledyne, which supplies the underlying electronics, data acquisition systems, and engineered components for those jets, suddenly has inventory piling up.
Right. They can't ship the parts, they can't recognize the revenue, and they absorb the carrying costs.
Exactly. It proves that a fortress balance sheet doesn't insulate you from the operational realities of your largest customers.
And that is the fundamental trade-off of this business model. You gain access to massive, sticky contracts that produce incredible operating leverage, but you simultaneously underwrite the production rate risks and regulatory hurdles of the aerospace giants.
So, synthesizing this deep dive into the Q2 2026 print gives us a very clear picture of Teledyne's current operational reality.
Yeah, they are functioning as a highly optimized cash-generating machine.
Definitely. They are heavily fortified by surging demand in defense electronics, counter-unmanned systems, and infrared optics within their digital imaging segment. And they're proving they can manage margins masterfully through product mix, absorbing the blow when legacy instrumentation lines face headwinds.
And they're operating from a position of immense financial power. With a leverage ratio of 1.1x and the capacity to pay down $500 million in debt in a single quarter, they are fully insulated from the high cost of capital that is currently suffocating their smaller competitors.
Right, and they have signaled clearly that they are actively hunting for M&A opportunities to consolidate their market share.
All while actively mapping and navigating an incredibly hostile macroeconomic landscape.
Yeah, managing supply chain bottlenecks triggered by the U.S.-Iran conflict, anticipating shifts in domestic environmental policy, and bracing for production delays from major commercial aviation partners.
It is a sophisticated, complex machine that is currently operating at peak structural efficiency.
Which leaves us with a lingering thought for anyone analyzing this sector. When you observe a company sitting on a $5 billion funded backlog, generating hundreds of millions in free cash flow, and armed with a pristine balance sheet designed to acquire distressed competitors during a high interest rate cycle,
Yeah.
is a company like Teledyne quietly becoming too structurally entrenched in the global defense and surveillance supply chain for competitors to ever catch up? Are we looking at the formation of an unbreachable economic moat?
It's a question every retail investor should be asking right now.
Absolutely. Hit that follow button so you don't miss tomorrow's daily earnings breakdown.